Welcome to a very special edition of Rebellion's educational series. I have a FinTech celebrity with us today, Professor Cong, the man who's been credited with coining the term quantamental. I've known him for about 10 years now. Brilliant professor who was at Chicago Booth, now at Cornell, and he was the first professor I came across and that I know of who's ever really taught applying AI in portfolio management. I mean, now it's spread like wildfire, but Lynn, you're just a treasure of information, and we're so happy to have you on today.
Thank you very much for the generous introduction and for having me.
Oh no, the pleasure is all ours. So let's get right to it. You've been doing some work on deep reinforcement learning. I saw you got published in Marcos Lopez de Prada's journal. Congratulations on that. That was maybe 2 or 3 weeks ago. Do you want to talk about some of your recent work on deep RL?
Sure. Yeah, happy to chat about that. You mentioned the Journal of Financial Data Science. It's a new journal that I think is gaining some attention because it provides a good outlet for some of these.
Yeah, it's the only journal my grad students want to get published in now at this point.
Right.
It's amazing.
Because with traditional academic publication channels, it's still a gradual process where researchers gradually learn more about these AI or machine learning tools, how they can be very useful for finance and economics or social science in general. One particular area that I've been working in is really applying cutting-edge AI tools to portfolio management, to finance problems. And I use the word cutting edge. We're using these tools not because they are cutting edge or popular, but we do recognize that they are cutting edge or popular for a reason, right? They have been proven to be very effective at playing games, AlphaGo, self-driving cars, computer vision, machine translation. So the question is, are they suitable for applications in finance? And one particular topic we look at is concerning portfolio management. In a joint work with my co-author Ke Tang from Tsinghua University and Jingyuan Wang and Yang Zhang, both of who are computer scientists, by the way, we look at how we can apply either transformer, which is pretty much the latest sequence modeling in AI and machine learning space, or long short-term memory that has been used a little bit more widely, to see how we can manage a portfolio better. But the idea is really started with an economic question, right? How do we manage portfolio traditionally in both academia and in the industry? We typically do it in 2 steps. The first step is, I can estimate the return distributions to minimize pricing error, or try to find the pricing kernel, or estimate the risk premium reasonably accurately. And then I construct my portfolio, right? I can use ad hoc weighing, I can use mean variance optimization. But the limitation with this is the first step has estimation errors that are hard to get rid of, hard to reduce to a satisfactory extent. So, and the 2 steps objectives are not always aligned. So what we hope to do is really directly optimizing a portfolio. Just tell me the objective of a portfolio, and we'll train a model to maximize that. Now, we're not the first one to attempt to do that. Traditional methods typically involve supervised learning. But what we have to recognize is, we can use supervised learning to minimize pricing error, right? So when I observe a stock return, I can use that as my benchmark to see if my model predictions deviate much from the observed historical correct asset return. But for maximizing a portfolio's objective, such as auto sample Sharpe ratio, there's no historically observed optimal Sharpe ratio. Now, if I try every possible combination to create my portfolio and calculate their Sharpe ratio, it's a huge computation burden, and it's not observed historically. And in practice, when we actually trade or construct a portfolio, it's going to have price impact. It's going to change the price dynamics of the underlying assets as well. So that is a typical setting where we need trial and error search. We need some long-term reward in mind, and these are what reinforcement learning does the best, right? If we, look at Sutton and Bartol's book, it's on the very first page. What defines reinforcement learning? Delayed rewards and trial and error search, and that's what we want to.
Yeah, the idea of when to give up your pawn for a rook.
Exactly, and it turns out to be very effective because reinforcement learning framework can allow us to incorporate price impacts, dynamic budget constraints, even time varying risk preferences by a particular portfolio manager or client. So these are issues that really make deep reinforcement learning suitable for portfolio management.
So I found that the major challenge for applying AI in finance is the changing market environments that we get. We have our .com bubble, then we have our post.com, bubble crash where then, value outperforms. And then again, the economy heats up and so on and so forth. For you, what are the greatest challenges in applying AI for portfolio management?
Yeah, so what you point out is exactly why we think AI tools might be useful as compared to traditional econometric tools such as linear regression. We can add in variable selection to improve it, but it's a different framework. You mentioned the environment is changing. I'm 100% with you. One thing I used to mention to my colleagues and students is, unlike physical laws or our DNAs that don't evolve very fast, which means, right, if I have a good machine learning model that works on a particular set of data, that's likely to work in other data sets because the fundamental principle, the way things work, don't change as quickly. But as you mentioned, in social science, economic policies change all the time. People's generational preference, I shouldn't use generational, I think it changes much faster.
No, true. But but it's a correct point you make. But yes, we are, the speed of the evolution of our society is increasing.
That is much faster. And also, I think there are a few other features that make financial data or economic data stand out, right? In sciences and engineering, where these machine learning tools were developed originally, we typically have a sparsity problem, right? But in economics, we typically have a lot of endogenous interactions. That's a difference. Signal to noise is much lower in financial markets than in a laboratory or engineering setting. And these are all issues that make us think, okay, can we just pull the packages directly and apply them to a portfolio management problem or any financial settings? And the answer is no. And I think that's the first challenge, right, we face when we apply AI tools. We have to modify it to make sure it's suitable for the question in mind. And what we did for this particular portfolio management problem is we look at transformer or long short-term memory. They are single sequence models. Basically, in more understandable terms, it's pretty much a time series problem or time series model. But what we really need when managing assets is a panel, right? A model for analyzing panel data. We have multiple assets, they interact. So what we try to do is we try to construct a attention-based network across the assets so that it allows us to analyze assets jointly in order to generate a portfolio. And it improves the auto sample Sharpe ratio by 0.4 with monthly rebalancing and all that. So it's definitely playing an important role. So
I've got to interrupt you. You bring up an interesting point about asset classes. You've done so much great work with Bitcoin and cryptocurrency and blockchain. I know you've been publishing a lot of research, really impressive stuff out there, Professor. But the recent run up in Bitcoin has just been insane, from $3,500 low in March to as much as 42,000. What is your view on Bitcoin? I'm sorry to be so simplistic.
Yeah, no, that's a good question. My views are evolving, but fortunately, it has been reasonably consistent. So I think the interesting innovation, right, is one of the earliest applications of blockchain, and it does solve a problem of validating a digital currency and using that mechanism to in turn ensure there's enough incentives to maintain the system, right? If you think about Bitcoin, it's essentially about record keeping. It's about generating a decentralized consensus. Now, coming to the valuation of Bitcoin, we chatted about this before. I've done some work on dynamic valuation of platform tokens. We can pin it to some fundamentals of the platform, for sure. Now, in the case of Bitcoin, I actually don't think there is much fundamentals to speak of, in the sense that if we are looking for anonymous P2P transactions, there are alternatives that are doing better job, that are less limited in terms of
XRP and Ripple, for instance.
Yeah, well, XRP is one example, and it keeps improving, right? Or the finality delay is not as long. But one thing I would give Bitcoin enthusiasts is it is true or reasonable to compare that to gold, digital gold. It's not so much about the transaction value, but if everyone believes it's a good store of value, and everyone is doing that,
storage space on faith.
The supply is very limited.
I mean, the market works on faith. Adam Smith's market. The market hand works on faith. We need faith, for everything to work. And so if there is consensus faith in Bitcoin, the faith itself will grow the value. I mean, when I talk to my students, they really believe in Bitcoin in a way you don't see with older generations.
Absolutely. I mean, and that's something enabled by technology to some extent, right? There is a credible way to limit the supply or the growth of Bitcoin supply. So in that sense, and to the extent that it's the first of its kind, it's already gained popularity and wide recognition. It's going to serve as a digital gold. But if we are looking for transaction media, or we're looking for other functions, Bitcoin is probably not providing those in the fundamental way. I'm not using Bitcoin to buy a coffee next door.
Yeah. No, the venture capital people I speak to seem to think Ethereum is the best bet from a transactional potential value.
I would agree with them. if we have to pick a relatively mature and widely adopted cryptocurrency for transaction purposes, or for writing smart contracts, or basically deriving some utility from the functions the platform provides, rather than just treating it as money only.
So,
Alex, if you don't mind, I also hope to add one point to what you were asking, the challenges we face, right, for applying these tools or studying FinTech. One is, I really think when we move from engineering or science to social science, I think there's great synergy. We need both engineers, computer scientists, statisticians, and social scientists, economists, to think about this problem. Many of the stablecoin designs are things central bankers have thought about before, right? And also for applications of AI, what is important is sometimes we need to know what's going on. I mean, the models are complex. We face some black box problem, but we should make an attempt to try to achieve interpretable AI. There's a line of development on explaining.
Interpretable AI is essential. Rebellion has spent so much time. We built extra code just to be able to interpret our predictions, so that our clients could know if we bought Daimler-Benz, why we bought Daimler-Benz, fundamentally, macro-wise, without a doubt. But cutting back to you specifically, you took this big job at Cornell. You're running a FinTech department there. I'd love to hear about that. What are you doing there now?
Sure. Yeah. Happy to share or report to our audience what it's not quite a department. It's an initiative that I started to work on with the the college leadership and my colleagues here, our idea is to have a platform, right? We don't want a center just for Cornell. We want to be the platform, the enabler that can empower all the participants, researchers, students to more actively engage in discussions and grow this area. And we're just glad we didn't define FinTech very narrowly. We do look at AI, for example, which is very important, AI, big data in business economics. And we've introduced a number of conferences that we hold, roundtables with industry leaders to, we are in a very applied field. So we need to make sure what we study in universities are relevant.
Yeah, no, you make a great point. And so much of what's being taught at universities will become irrelevant and obsolete. I mean, I went to Amherst College, a liberal arts school, where quite frankly, beyond my mathematics, there was, I studied architecture and art and poetry. And I bonded with the chair of the math department, actually had her on my board for over a decade. But outside of mathematics, there's nothing for practical, usage. And so FinTech is something that every university is going to have to concentrate on if they're going to want to stay relevant.
Exactly. And that's where the conversation with industry leaders and researchers will be very useful, as well as just communications among researchers around the globe. And that's something we are actively working on. And, I owe many thanks to the early leadership at the Review of Financial Studies. Andrew Crowley, Wei Jiang, and Ipei Goldstein, they jump-started, the FinTech special issue that really, I think, kind of started this whole growth in FinTech research in finance and economics. And we're just trying to continue to grow that effort and community.
I was working on a research project with a few Cornell students last summer, and they were saying, oh, we really hope we get into Professor Cong's class. And I had this big smile come across my face. I was like, oh, God, Professor Cong's gotten so in demand. And so, I've been seeing you everywhere. You really just become this, celebrity professor. I'm, so awesome to see your growth. And obviously, we're so honored to have you on today. Before I let you off, is there anything you want to finish with our viewers? Tell us about your most latest work or any ideas you want to share.
Yeah, sure. I'm happy to, quickly share some of the, I think, exciting directions and projects in this field, especially related to, AI. I know you've done a lot of work on that for your fund and also through this educational effort. Kind of tying back to the interpretability part, I do think natural languages, alternative data, be it text or audios, videos, could provide a lot of information. And in terms of natural language processing, we have the tools from the engineering side. The key challenge we face is how to connect that to social scientists, right? How we can effectively utilize those tools. So one thing I've been working on is what we call textual factors. The idea is...
Say that again, a what?
Textual factors, right?
Textual factors,
we know
okay. Yes.
asset pricing factors, say from our French, 3 factors. But here, once we go to the textual universe, right, the vector space that represents alternative unstructured data, we can also have a factor structure, basically a basis for that space that are interpretable. That could help us to, perform many diagnoses on models and interpretation of models. So that's one area I'm really excited about. Another area is really applying AI to actually to help mitigate or in terms of policy recommendation add to what we are experiencing right now, right? How do we mitigate COVID-19? How do we plan policies for reopening? And I think AI and economic insights will be very useful. Most of the epidemiology models take, for example, transmission rates as either time invariant or exogenous, but we know economic incentives matter there, right? If there are more confirmed cases out there, we don't want to go out as much or move as much. But if economy is being slowed down, people are unemployed, we have to go out and carry out economic activities. These are going to endogenously drive the transmission rates, and we can also evaluate effectiveness of policies using concepts that we've used in finance, right? Mean variance frontier, and here we could have a house improvement versus economic improvement frontier when evaluating policies. So these are things that I'm quite interested in examining, and so are some more advanced AI tools, right? GN, graph neural nets, applications in analyzing social network or economic linkages. These are topics I hope more people would pay attention to, and it's really wide open, and there are so many exciting and relevant issues in this area. I'm just looking forward to exploring this together with many of you.
Well, Professor Cong, thank you so much for coming on today, and I really appreciate your time, and I hope you stay safe during these crazy times we're in.
You too. Thank you very much for having me here.
The pleasure is all mine. Thank you, Professor.